To the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. Just before we kick off, I'm just going to ask you to quickly read through this risk warning. I'm going to pop myself on mute, so you can just take your time and read through. Excellent. So as always, we'll start by just taking a look at the economic calendar on the City Index website. This I have filtered for next week, and I have also filtered it for high impacting events. Now, there's not really too much going on at the start of the week. In fact, things don't really start to heat up until Wednesday, when we have the US inflation data. Now, this is expected to be the highlight of next week. Inflation is expected to actually tick higher again to 3.4% year on year, up from 3.2%. But on a monthly basis, is expected to be at 0.3% after climbing 0.4% in the previous month. Also, we've got core inflation is actually continuing to trend lower. Now, if we think about the data here, there have been some concerns over sticky inflation. We've seen hotter than expected inflation at the start of the year, which has just got the market questioning whether the Federal Reserve will be able to cut interest rates 3 times, as it signaled that it would do at the last FOMC meeting. Now, interestingly, this data comes after the US non-farm payrolls, which, as we've seen, were much stronger than expected. So that's also going to keep pressure on the on inflation. So if let's just take a look at what this means for the different markets. And I think the other thing to bear in mind is, if we think about this data point, it's coming, I think, at a relatively clouded outlook as far as sort of, the Federal Reserve and whether they'll be cutting rates or not. If we just have a look at this is the US Fed Watch tool on the CME, and it's showing around a 35% probability that interest rates will be left on hold in the June meeting, and around a 65% probability that they'll be cut. So we've actually got the first Federal Reserve meeting on the 30th of April with the interest rate decision on the 1st of May, but no change to policy is expected at that meeting. The focus has been on when is the Federal Reserve actually going to start cutting rates. And actually, the market had been focusing very much on June, with the first fully priced in rate cut expected in July. What we're seeing now following the US non-farm payroll results is actually the market is now fully pricing in that first pay cut in September. So we're actually seeing rate cut expectations being pushed out. Now, if we get hotter than expected inflation data next week, then that could see those interest rate cut bets being pushed out even further. If we get cooler than expected inflation, and that comes coupled with the slight downtick in services activity, then that could keep the markets contender. The Fed may still look to cut interest rates 3 times this year. Let's not forget, this week we have had some mixed messages as far as the Fed is concerned. So we had Federal Reserve Chair Jerome Powell saying that the Federal Reserve could actually still supports cutting interest rates this year. But he didn't really give any idea on timings or scales, and he also sort of said that policymakers need to see more evidence that inflation is cooling back towards 2%. However, yesterday we had Neil Kashkari, Minneapolis Fed president, saying that actually he doesn't really know whether the Fed's even going to manage 2 rate cuts this year. And those comments, this is the US dollar index that we're looking at here, those comments helped send the US dollar higher, recovering from this low point here. We have seen sort of, the coming off of the US dollar on those comments by Federal Reserve Chair Powell, and the market again getting optimistic or pulling in rate cut bets. And then we hear Neil Kashkari saying, actually, not so sure. He's not a voting member at the moment. So, but even so, it seems like, US dollar bulls are keen to pull on to anything that might suggest that a rate cut is going to be happening at a later date. Also, we've got supporting the US dollar is those safe haven flows amid rising concerns over geopolitical tensions in the Middle East. Now, just as far as levels are concerned, we can see that 105 level, that's a pretty key level here. It's the one that we saw in February, also the high in April. Now, if we just have a look about where the dollar is, it's actually still trading pretty much in the middle of the range, maybe just towards the upper end it reached. But look, we've got this long lower wick here as it came down and found support around the 200 SMA, which is around the 103.80 level. But that long lower wick suggests there was little demand on little selling demand, which is why we see that long lower wick. But then if we look here, we've got a pretty long upper wick as well. So there isn't necessarily that much demand at the upper end of things either right now. But I think as far as levels to watch, buyers are going to be looking to get the price back over that 105 level to create a higher high and extend the bullish run. This level here is going to be pretty key around the 103.90, 103.80, which is the 200 SMA, and we've also got the weekly low. If we get a breakdown there, then we'll be looking at this level here around 103 and also the 102.50, which is the March low. Now, it's also good whilst we're looking at the dollar just to have a look at what's going on with the with gold. Gold has been very much in focus this week as it rose to fresh all-time highs. There we go, fresh all-time high from gold again, even though we got stronger than expected US on-farm payrolls and rising yields. So this has been a really interesting story with gold. We've seen it push to fresh all-time highs as even as there are sort of doubts over whether the Federal Reserve is going to cut interest rates imminently or not. Imminently, I say that June. But still, the fact, gold performs well in a lower interest rate environment. And so we're seeing this run higher on expectations that the Federal Reserve will start to cut interest rates soon. The gold is also being supported by safe haven flows as we've got those concerns in the Middle East that seem to be ramping up, real concerns that Iran might be drawn into the Israel-Hamas war. And then you've also got central banks buying up gold at a stronger rate, as well as gold being a hedge against inflation. And inflation, it looks like it's going to be a little bit sticky. So as far as levels are concerned, I think we are in overbought territory and really quite far in overbought territory. So a period of consolidation would be expected, if not a pullback. But then if we just have a look at this long lower wick there, that again suggests that selling demand at those lower levels just isn't there. So that would suggest that the price could continue to push higher. Bulls are going to look to get over the 310 to continue, the 2,310 level to push towards 2,400 is going to be the next level on the upside. On the downside, I think there is some support really. We've got today's low, which was the 2270. It's going to be a minor support, but if we can get that out, there's this level here, which is the rising trend line support, as well as the previous mid-March, that was the all-time high at the moment of 22.22, and a breakdown there brings in 21.95 into focus. But really, I think as long as we sort of stay above the 21.45, I think the outlook here is still fairly bullish for gold prices. Next up, the other thing to talk about as far as the US is concerned is earnings season. So we've got banks kicking off earnings season next week. I mean, just as far as earnings season is concerned, we've got S&P earnings Q1 for 2024 expected to see earnings rise 2.5% and revenue increase 3.5%. This comes after earnings growth of 6.7% in the end of 2023 on revenue growth of 3.9%. Now, I think it's not really that surprising. We're expecting the tech sector to be boosting the earnings, and energy is expected to act as a drag. Now, what's really interesting is the Magnificent Seven. Actually, their earnings growth is expected to be around 33% higher on 13% higher revenue. Now, if we take out the Magnificent Seven earnings growth from the rest of the index, the rest of the index is actually set to experience around 3.2% decline. So I think that's really interesting. It tells us that really those Magnificent Seven, we could probably take Tesla out of that now, to be honest, but they really are holding up the rest of the index still as far as earnings is concerned. Now, financials, that's one we're going to be focusing on, seeing that we have earnings from JP Wells Fargo and Citibank next week. Finance sector expected to see Q1 earnings a 3.7% increase on 2.4% higher revenue, but this comes after a 12.5% earnings increase in Q4 2023 on an 8.4% increase in revenue. So we're really seeing that moderated. I mean, it's still growth, but it's growth that has been moderated quite considerably from previously. So as I said, we've got JP Morgan will be releasing their earnings there as well. If we just have a look at the chart here, we can see it's trading up around all-time highs. I mean, it has just come down from all-time highs. But I think broadly speaking, in the financial sector, we can expect to see the sort of net interest income supported by rising loan growth, even if that sort of offsets slightly a modest decline in margins. I think we could also expect markets, capital and equity markets, to perform well. There will be the areas to watch out for. Also, bad loans. Look out for bad loans. In the end of Q4 2023, bad loans from some of the top banks, including JP Morgan, Wells Fargo, Bank of America, and Citibank, that totaled 24.4 billion. So that is a big number. So we're going to be watching to see whether those bad loan figures, bad loan provisions are starting to decrease or at least steady, which would be an encouraging sign. If we're seeing larger bad loan provisions, that would be perhaps a cause for concern. So yes, we're seeing this consolidation here on JP Morgan below that 200 level. It's brought the RSI out of overbought territory. I mean, immediate support, I think, is down here at 192, but which was the last week's low. And then we've also got a breakdown there. Then you'd be looking at the mid-March low of 185. But, you know, if we get some strong data coming through from some strong numbers coming through from JP Morgan, then we could see fresh all-time highs. Just finally, want to have a quick look at what's going on with the Dow Jones. So as I said, you know, we've got a lot to watch next week. Not only have we got the inflation figures, we do also have FOMC minutes, which are set to be released on the same day as inflation, just later on. And that data, as well as earnings season kicking off, could mean that we see some volatility in the equities market. Now, if we just have a look here on the Dow Jones, it's experienced its worst weekly performance since the start of the year. You can see this is where it's really fallen across the board. But I mean, if we have a look at the fall down in comparison to, or in relation to the rally that we've seen, it's really not necessarily that big, but I mean, it's still pretty hefty fall. We saw a 500-point drop in the previous session, found some support here around the 38.50 level, which is the March low. If we can see if this support holds, then buyers are going to potentially look to try and get back above that 39,284 level, which was the February high. But you know, we've had that move, that strong engulfing candle there. We do get a break below this level at 38,500, then that brings 38 into, so 38,000 into focus, which is the February low. So yeah, that's the Dow Jones. Let's just continue having a look at what else we've got going on. So we've got the Bank of Canada interest rate decision. Bank of Canada is expected to leave rates on hold at 5%. It's going to be a fairly interesting meeting. I mean, if we think about what happened in the previous meeting, the Bank of Canada suggested that, and also what we've heard in sort of comments from policymakers since, is that, you know, the economy is slowing, that progress is being made towards the central bank's 2% target for inflation. We've seen inflation CPI fall to 2.8% in February. That's down from 2.9% in January. So again, you know, signs of inflation cooling towards target. First rate cut was being priced in for July, but if you can see, we've had some jobs data in from Canada as well. And actually, it showed a sharp downturn in the jobs market, which is really interesting. Unemployment jumped higher to 6.1%. And employment levels fell by 2.1%. They were, and that was after a 40,000 increase last month, in the previous month, and expectations of a 20,000 increase. So a real slowdown in the labour market, which I think is going to catch the eye of the Bank of Canada. And we can see that came at the same time that we've had this really strong data in the US, and that sent the loonie sharply higher. So if we have a look, I mean, it's taken out this support level here at the 135.85, which was the April high. It's taken that out. It pushed up to a high there of the what level is that? The high today of 136.50. Now the price has actually come down back to this 136.20 level. This is the level that we've seen really capping gains here across March. It's a level that's been important back in December as well. So I mean, that's looking like a strong move higher. Bulls are going to look for a close above the 136.20 and above 136.50 to keep that bullish move going. As far as support is concerned, here we go. That's the 200 SMA we've got in there at 135, and also this weekly low here of 134.80 on the downside. Other ones to think about, we've also got, so we talked about the FOMC minutes. Let's just move on now to the ECB whilst we stick with interest rates. ECB are not expected to move on interest rates. They are expected to hold steady at 4%. Now there have been sort of some suggestions, will the ECB start to cut rates in April? I mean, if we think about it, inflation has cooled to 2.4%, which was below the 2.6% forecast, down from 2.6%. It was lower than expected. We've seen that the manufacturing downturn has deepened. We have seen some momentum picking up in the service sector, which will be encouraging, but retail sales were also down. They were worse than expected, with another drop of 0.5%. So, you know, we're seeing that the Eurozone economy is under pressure and inflation is cooling. As I said, will ECB policymakers cut rates in April? Probably not. I mean, they have signaled quite consistently that June could be the month where they start to cut rates. We do know that the ECB was concerned about wage growth. ECB President Christine Lagarde has said that strong wage growth is a hurdle to cutting interest rates. Now, wage growth has started to cool, but we expect the ECB will want to see wage data in May before taking a decision on whether to cut rates. So that probably puts an April rate cut off the table. Having a look here at the euro US dollar, you know, it has been trending lower. We see this again is to do with that dollar strength that we've seen across here, but it has recovered from that 107.25 level, just testing the 200 SMA here at 108.30, and that seems to be a key level that the price is trying to cross. We can see again, long lower wick here could suggest that there wasn't really much selling demand at those lower levels. You know, it spiked below the 108 support, but is back up above 108, testing, as I said, the 200 SMA. RSI is pretty flat at neutral at 50. So we're looking for a breakout trade, really. I mean, I think on the upside, buyers are going to be looking for a break above 108.75 weekly high to then bring 109.85, the March high, into focus. Sellers are going to be looking for a break below the 108, this week's low, 108.90, 107.90, but the 108 more or less, around that level to get that 107.25 back into focus. That was also the low in December, so a fairly key level, 108, 107.25 as well. So that is as far as we've got. I think the other one to keep in mind, and I've not really mentioned this, sorry, was with the loonie. So one of the reasons that we had seen some resilience, if we just do a comparison with that previous chart to the Canadian dollar, we can see the Canadian dollar has been holding more steady against the dollar, against the US dollar, compared to the euro, and that's basically because it's been supported by stronger oil prices. Now, oil is going to be in focus, I think, again as we move into next week. Oil prices have been climbing higher. They're trading at 5-month highs, and this is on a couple of pointers here. Obviously, we've got these escalating geopolitical tensions in the Middle East, and there are these concerns now that Iran is getting drawn into the Israel-Hamas war. Iran have said that they will retaliate against Israel, who they blame for an attack on their embassy in Syria. So there are concerns that will escalate the war further. Iran is the 3rd largest OPEC member, so a big oil supplier, and so, you know, that suddenly that does put a larger risk premium on the price of oil. Oil is also supported not only by these concerns over supply from the Middle East. We've got the OPEC group, which voted to maintain output cuts, which keeps supply tight. And then at the same time, this week, we've had stronger than expected manufacturing data from China, suggesting a recovery in the sector. The largest, in China's the world's largest oil importer. Also, the US has seen a recovery in manufacturing. So these are all sort of factors which point to increasing oil demand. Just as far as the chart is concerned, watch, we're in overbought territory, so some consolidation could be on the cards, but, you know, looking up to around $90 a barrel seems to be the next hit as far as the bulls are concerned. As far as support is concerned, we've got this around the 84.70 level, which is the August 2023 high, also the swing low just yesterday, and then from there we've got the high of 83.10, the mid-March high, which could offer some support as well. So that's, and then finally, just let's squeeze in, we've got inflation from China. Now this is going to be really interesting. We're expecting that it could ease after a ticking higher. So this is going to be under control. I mean, we do have seen signs this week that the Chinese economy is starting to recover. As I said, the manufacturing sector was stronger than expected. Service PMI were also stronger than expected. So these are encouraging signs, but weak inflation is something that China is struggling with, especially at a factory gate level. Now, when we're talking about China, obviously resource stocks such as oil is one to be watching. The other one I'm going to be watching quite closely is the FTSE. The FTSE has risen to close to its all-time high this week, but it has actually now fallen off quite sharply. We've seen it sort of fall away from the 80.15 level, dropping to a low today of around 78.50. It looks like it's going to trade, it looks like it's going to close above this support here at the 78.80. And that's a level that we saw back in January 2023. So, you know, there's still this upward trend going there, but that support, I think, really does need to hold in order for bulls to be able to get back up to the 79.60 and up to 8,000 and on to 8,045, which is the fresh, which would then take it to fresh all-time highs. If we do see a break below 88.80, then I think this is the next one in line here, which would be around the 7,800 level. Excellent. Thank you so much for joining me. I do hope you've enjoyed it. And if you have enjoyed it, then do check out our YouTube channel for more videos like this. Otherwise, I will see you next week.